So in this segment, we'll look at the statement of profit or loss account. So this is the statement of profit or loss. So first you have the revenue number, then you deduct cost of sales, and from that you will get the gross profit. So from gross profit, you deduct operating expenses such as administrative expense, selling and distribution expense, and any other operating expense, and you will get your operating profit. From operating profit, you deduct non-operating expenses. So what are non-operating expenses? We will see later in this video. So one of the example is interest, which is it can be an expense, and add any non-operating income that you get. So for example, not from your business, but you're from any of the investments that you have made. Okay, investment income or dividend income. So after adding your non-operating income, you will reach at profit before tax, and direct the tax you will reach at the profit for the year. So the statement of profit or loss ends with profit for the year. So the profit for the year can also be called as net profit. So there are like three profits that are available in the statement. So one is called the gross profit, the operating profit, and the net profit. Okay, so why do we have these three kinds of profit? Okay, what is the significance of them is what we are going to see in this video. We'll also be looking at what are the various terms here. So what is revenue, like what is operating expense, what is non-operating expense, what is non-operating income. Also we'll be like looking at this video. So these are the elements that we'll be looking at. So we'll start with revenue and expenses. See, revenue is the income generated by the operations of a business for a period. Expenses are the cost of running the business for the same period. So IASB's or IFRS conceptual framework defines income, revenue and expense as follows. So there's a definition for each and every single item here, and only if the transaction meets that definition, it can be recorded. So income's definition is this. Income is increase in economic benefits during the accounting period in the form of inflows or enhancements of assets or decrease of liabilities that result in increase in equity other than those relating to contributions from equity participants. So what does this mean? See, income is any increase in economic benefit. Okay, so it can be an economic benefit can be something like a rent, okay, rent received, or a payment received, or a goods sold. Okay, anything can be an economic benefit, but this economic benefit should have occurred during a specific accounting periods like 1 year or one operating cycle in the form of inflows, okay, or enhancements of assets. So uh, that could have been sometimes the asset value could go up. Okay, so that can also be recorded in statement of profit or loss. Decrease of liabilities, sometimes decrease in a liability, for example a decrease in a provision. So a decrease in a provision can be considered as a inflow in a particular year or an income in a particular year, because that also will increase the net profit that result in increases in equity. Okay, so we'll leave the last sentence. So what are expenses? Expenses are decreases in economic benefit during the accounting period in the form of outflows. So this is like exactly opposite to a income. Or depletion of an asset. So depletion is like a depreciation of an asset or obsolescence of an asset. The value of the asset goes down. So that is a expense. Or incurrence of a liability. So incurrence of a liability is, for example, we have a provision for tax and now the tax has to be paid. Okay, so a liability now becomes a expense. Okay, so incurrence of a liability that result in decrease in equity. So again, with the last sentence we'll just ignore it. Okay, so income is any economic increase in any economic benefit, expenses are any decrease in economic benefit. Okay, and it's only for a particular accounting period only. So now we will see revenue alone in detail. See, revenue is the income generated by the operations of a business for a period. Revenue is also called as top line, okay, because revenue is the first item in the SOPL account. Revenue can also be divided into operating revenue. Okay, so operating revenue is assume that you are a car manufacturing company. Okay, any income that the car manufacturing company gets by selling cars, it's a core business income. And non-operating revenue, which is derived from secondary sources. The same car manufacturing company, if they are going to invest uh, in a bank deposit and they are going to get an interest, that interest is a non-operating revenue because it's not coming from the sale of car but from a deposit. Okay, so when the income is coming from not from the main business but from any secondary kind of investment, then it's called as a non-operating income. Revenue or operating income is derived from normal business operations. For example, the following are different sources of revenue or operating income. So sale of goods or sale of service can be the operating income. Okay. So for example, if you take a manufacturing company, car manufacturing company, they also do services, right? They also do maintenance and services for a cost. Okay. So that is also their operating income because they are servicing the car. Okay. They're maintaining the car. So the car is their main business. Okay. So production and service of the car are both operating income. As these operating revenue sources are often unpredictable or non-recurring, they can be referred to as one-time events or gains. Okay. See, non-operating revenue can also be like one-time income. For example, the same car manufacturing company sells an asset. Okay, sells a machinery. So because of that machinery, they get a income, right? Because of selling the machinery, they get a income. See, it's a one-time income, right? It's not a regularly they are going to keep on selling the machines. Okay, what they're regularly selling is the cars, not the machines. Okay, so non-operating revenue or income can be like one-time incomes. So the following are the different sources of non-operating incomes. Okay, so interest income, royalty income, dividend income, sale of an asset, profit on investments, or compensation from legal cases. Okay, so these can be like non-recurring or one-time kind of a incomes. So we look at expenses now. An expense is the cost of operations that a company incurs to generate revenue. Okay, so to make revenue, the company has to do some kind of activities, and these activities incur a cost. Expenses are tax deductible, so you get tax benefit if you are like having more expenses. Again, here also you have like two types of expenses. One is operating expense, other one is non-operating expense. So operating expenses relate to the operations of the business. Okay, so if you're a car manufacturing company, so the cost of goods sold, the cost of production, the salary you pay, okay, the rent you pay, the electricity bill you pay, the administrative fee, the rent, lease, all these things put together are operating because these expenses are required to manufacture a car. Okay, so these are operating expense. So what are non-operating expense? Okay, see, non-operating expenses are something which is not directly involved in the main business. Okay, it's not involved in the main business. So the best example is interest. Okay, so you can run your business either by your own money or borrowed money. Okay, but the borrowed money has a charge, it has an interest charge. Okay, see, this interest is not an operating expense. Okay, to run your business you need money, but you could have used your own money, but instead of that you could have gone for borrowing. The interest is a non-operating expense. Okay, so that is how it's usually classified. Capital expenses is different than most other business expenses. Okay, so capital expense means like uh, you are spending some money for an acquisition of an asset. Okay, you are buying an asset, so these are capital expenses. So capital expenses are capitalized and converted into assets. Okay, so usually these expenses are called as revenue expenses. Okay, and capital expenses are huge amount of expenses which are actually assets. So now we look at what is gross profit. Gross profit assesses a company's efficiency at using its labor and supplies in producing goods or services. Okay, so if you take the revenue of the business, okay, From that you deduct your direct material. Okay, to produce the car, what is the material you used? To produce the car, what's the labor you used? To produce the car, okay, what is the commission that you have paid to your sales staff? Utilities of production site. Okay, in the production site, what are the various other costs which are involved? Okay, see, mostly gross profit tries to find out at the manufacturing level. Okay, at the manufacturing level. Okay, from there to whether the company is able to make at least a profit at the manufacturing level here. If they are making a gross loss here, then the company is like impossibly useless to be run. Okay, so companies should make gross profit. So this is the formula here: revenue minus cost of goods sold. So usually a company might have different divisions of business. To know the profitability of each division, gross profit is the ideal metric. Okay, so for example, if you take a company like ITC, you take a company like ITC. Okay, look at their business. So these are the businesses. See, they are into cigarettes, foods, personal care, uh, education and stationery, lifestyle retailing, matchsticks, okay, safety matches, agarbattis. Okay, they are also into hotels, paperboards, packing, agri, IT. Okay, so they are into like so many divisions. Okay, how do they know which division is like contributing how much profit? To know at that level of profit, they have to do a gross profit. Okay, so at gross profit level, are these divisions making profit or not? You have to get that idea. Okay, so that is where gross profit is like really useful. So when a company has like several divisions, to find out whether each division is making profit, you have to do you have to find out the gross profit. Okay, if a company or a division has a gross loss, it is very difficult to operate the business because there are still several expenses that has to be incurred after the gross loss level. Okay, see, gross profit is the first profit. If that itself a company couldn't make, then there are still several expenses. For example, there are still operating expenses, non-operating expenses which are there. Okay, so gross loss is there, then there is impossible. The company will make only more losses in the statement of profit and loss. Okay, so you could see here, you could see in this point what we are like deferring here. So if this level, okay, itself is a gross loss, still there are expenses. See, there is here expense here, there's an expense here. So these are like more higher level of expenses. Okay, so if this itself is a loss, this expenses will also reduce the operating will profit will also be a loss, and the net will also be a loss. Okay, so that's what is the problem here. A business having gross loss will have net loss only and mostly would be bankrupt in next few years. Okay, so you can even be very sure about that. So now we look at operating expenses. Okay, so after the gross profit level, we have the operating expense. So what are operating expense? Operating expense is also called as OPEX, is the necessary and unavoidable expense a business incurs for running its normal business operations. Operating expense include rent, repair, maintenance, marketing, payroll, insurance, depreciation, and amortization. Okay, so it includes all uh, non-production expenses. Management must ensure to reduce operating expenses without majorly affecting the firm's ability to compete. Okay, so the company has to try to reduce these costs. Okay, but are not affecting the quality of the business. So again, operating expenses are tax deductible, and finally you will be like leading to operating profit. Okay, see, operating profit is calculated by subtracting operating expense from gross profit. That's what we saw in the statement. So this is the formula: operating revenue minus COGS will give you gross profit. From there we deduct all the operating expense, depreciation and amortization will lead to the operating profit. So now operating profit excludes any profits earned from the firm's ancillary investments such as earnings from other business a company may be partially invested in. I think this statement we'll leave it. Okay, this is a little bit advanced same statement. We'll leave this. So operating profit is also called as EBIT. Okay, earnings before interest and tax. So now we look at what are the non-operating expenses. Operating profit excludes any profits earned from the firm's ancillary investments, such as earnings from other businesses a company may be partially invested in. So this statement refers to non-operating income. Okay, so non-operating income would be like added hereafter to the operating profit. Okay, so operating profit only includes the operating income and operating expenses. Okay, so from here on we will be like adding or considering non-operating expense and non-operating income. Okay, so operating profit is also called as EBIT, earnings before interest and tax. So now we look at non-operating expenses. A non-operating expense is a business expense unrelated to the core operation. Okay, so it's not related to the core operation. So in a car manufacturing company, these expenses are not related to the manufacturing of cars at all, or the any relation to the car concept at all. Okay, the most common types of non-operating expenses are interest charges and the losses on the sale of asset. So these are the usual non-operating expenses. Interest payment is considered as a non-operating expense because it does not arise due to a company's core operations. Okay, if a company sells a machine and it is not in the business of buying and selling machinery, the sale of the machine is a non-operating activity. Okay, so for a car manufacturing company, if it sells a machine, okay, that sales of a machine is not their main business. Their main business is to manufacture the car. Okay, and now they are selling a old machine. So that old machine is not their core business. Okay, if the machine is sold at a loss, the loss is considered as a non-operating expense. Okay, so the machine is not the core asset of the company or the core business of the company. So they would just be considered as a non-operating loss. Okay, non-operating expense. Unless usually remove non-operating expenses and non-operating income to examine the performance of the business, ignoring effects of financing and other relevant issues. Okay, so when investors are considering to invest in a company, they usually don't look too much on the non-operating expense. Okay, so of course they will consider the interest. Okay, but non-operating expenses are like one-time expenses or one-off expenses, so usually they don't look at it a lot. Non-operating expenses are again deducted from operating profit and accounted for at the bottom of the company's income statement. Okay, so I think this we saw in the statement itself. So now we look at the net profit. See, it is computed as the residual of all revenues and gains less all expenses and losses for the period. So it is the final number and has also been defined as a net increase in shareholders' equity. So this is the number which is going to increase the owner's income that results from the company's operation. So this is what is going to be like going to the equity shareholders' pocket. Net profit can be distributed among equity shareholders as a dividend or can be added to retained earnings. So from net profit, you can do two things. Either you can give it as dividend, or you can add it to the retained earnings. Net profit is also called the bottom line because it is typically found on the last line of a company's income statement. Okay, so it's called as a bottom line. If a company or division has a net loss but gross profit, it is possible to operate the business because there might be ways to revive the business. Okay, see, if a company has only a net loss but but it has a gross profit, then at least there's a chance to improve the company. But if a company has a gross loss, it's like hopefully impossible to revive it. Okay, it's like impossible to derive such kind of a gross loss companies. If a business has net profit, it should be analyzed as to how much of the profit is due to the operating income and non-operating income. Okay, so just because there is net profit, we should not be happy. We should find out like whether it's coming from operating income, non-operating income. We should also see whether the expenses are operating expense and non-operating expense. Okay, so just because there is profit, we should not be like happy. We should have to like find out why it has occurred or where it has occurred. Okay, so with this we have like completed the basic terminologies in financial statement and profit or loss statement. Okay, so thank you very much for watching this video. We'll meet in the next video.